If you're in the top tax bracket and you itemize deductions, OBA just made a new limitation that could reduce your deduction. Starting in 2026, the highest earners will see their itemized deductions reduced by a new formula. Now, this is day 27 of me breaking down the One Big Beautiful Bill Act for the next 30 days, so let's get into it. So here's a new restriction. Now, before OBA, there was no limit over the itemized deductions for 2025. You could deduct the full amount of your mortgage interest, charitable contributions, state taxes up to the cap, and medical expenses. Now, after OBA, starting in 2026, under Section 68F, taxpayers in the 37% tax bracket will reduce their itemized deductions by a specific formula. Now, you must reduce your deductions by 2/37 of the lesser of A, your total itemized deductions, or B, the amount by which your income exceeds the 37% bracket threshold. So first things first is, who does this affect? It's only taxpayers in the 37% tax bracket. So if you're a single filer and your income is over $626,350, or if you're married filing jointly and your income is over $751,600. If you're not in the 37% tax bracket, this doesn't affect you. Now, number two is, let's do the math here. So for example, let's say we have a married couple and they have $900,000 in income. And then let's say they have $60,000 in itemized deductions. The 37% bracket starts at $751,600 of the amount over the threshold. So $900,000 minus $751,600 equals $148,400. The lesser of A, $60,000, their deductions, or B, $148,400, which is the amount over the threshold. So the answer is $60,000. The reduction was 2/37 times the 60,000, totaling $3,243. Their $60,000 in deduction became $56,757. At the 37% tax rate, this cost them an extra $1,200 in taxes. Now, number three is, this is a Pease limitation. It was named after former Congressman Donald Pease. It existed before the 2017 Tax Cuts and Jobs Act. It was eliminated, and now OBA brings back, a modified version. Now, number four is what deductions are affected. It's all itemized deductions. So mortgage interest, charitable contributions, state and local taxes, medical expenses, and investment interest, but not medical expense floors, investment interest limits, or casualty and theft loss. Now, number five is, this is a way to raise taxes on high earners without changing tax rates. The 37% rate stays the same, but deductions are worth less. Now, number six is, combined with the SALT cap and this new limitation, high income itemizers in expensive states face a double restriction starting in 2026. Now, number seven is, this starts in 2026. So your 2025 tax return filed in 2026 is not affected. This applies to tax year 2026 that will be filed in 2027. So that's your day 27 update.